Hi, I'm Justin Hyland of Hyland Financial Planning, and welcome to this important update. At the outset, let me make the observation that neither you nor I will be talking about coronavirus in 5 years' time, let alone 10 or 15 years' time. And that should provide the kind of perspective that you require to navigate this period of market volatility successfully. Coronavirus continues to rattle investment markets as the number of new cases outside of China continues to rise and is posing an increasing uncertainty over the impact of economic activity. And it's this impact that has been intensified following the plunge in oil prices recently. So from their highs, global shares and Australian shares have had a fall of about 20%. It seems there's two extreme views on coronavirus. Some see it as a bad flu and they can't see what all the fuss is about and they don't understand it. Others think that it will have it'll trigger a major humanitarian and economic catastrophe, killing millions, and it'll also trigger a major global recession. The optimist in me leans towards the former, but I must concede I just don't know. And neither do many economists. There's much that is unknown about the virus itself and how long it will continue to spread. And a cure may be 12 to 18 months away. So given all of these uncertainties, it's still too early to say that shares, commodity prices and bond yields have bottomed out. The following chart presents three scenarios for our economy. In 2019, this is how we saw growth panning out prior to the virus, and up until that black line of 2020. So from 2020, the base case shows mild downturns in the March and June quarters, driven initially by the lockdown in China, and then the coronavirus flowing on to the rest of the world and even down to Australia, followed by a rebound in the June quarter back to where our base case was at the end of 2019. A worst case downturn would see that a deeper share market falls in March and June quarters, then followed by a rebound and life returns to normal, but just a little bit later. The rapid fall in share markets has been quite scary. And in our view, the key things to bear in mind are periodic sharp falls in share markets are healthy and normal. And with long-term trends ultimately remaining up and providing higher returns than other more stable assets like cash and term deposits, I implore you to see Will Douglas's video below on the history of volatility. It's quite interesting. Selling shares or switching to a more conservative investment strategy after a major fall will just lock in a loss. When shares fall, they're cheaper and they offer a higher longer-term return prospect. We'll look for opportunities in the pullback, and it's possible that from time to time we'll average you in at the right time for your investor risk profile. While investments have fallen, dividends from our share market haven't. Companies like to smooth their dividends over the longer term, and dividends never go up as much as the company's earnings in the good times, and they rarely fall as much in the bad times. The best way to stick to an appropriate long-term investment strategy, let alone see the opportunities that are thrown up in the rough times, is to turn down the noise. So as you turned on the news on Monday evening, or you read your preferred newspaper, you would have been greeted with the news that markets have fallen significantly. And at the close on Monday, the 9th of March, the Australian share market was down 7.3%, its biggest single day fall since the global financial crisis. And what this means in real numbers though, is that many portfolios are now sitting at or around where they were in January 2019. And whilst these falls are large, it's important to note that the portfolios that we build for our clients are diversified in terms of the assets inside them, the fund managers and the investment styles that we select. And what this means is that as of last Friday, when the broader market was down over 11% for the last month, our defensive portfolio was only down about 5.6% and our growth model portfolio was down about 8.2%. Interestingly, investors in the defensive model remain up about 8.9% for the last 12 months, and the growth investors are up about 10.2% for the last 12 months, even after factoring in all the falls, so we're quite pleased. It's important that when you're reading the headlines, you have all of the data to ensure you can better respond to negative news. And as for many of our clients, their portfolios are faring much better than the market, and investment fund managers are making decisions on your behalf, and we have confidence in the assets that they hold. The current market volatility is just that. It's volatility. Investment earnings and fundamentals will be impacted by the slowing world economy, and frankly, that was happening anyway. A stimulus-driven switch in sentiment sparked a rally on the Australian share market of about 6% on Tuesday. You can see that in this graph. For now, please do your best to look past the headlines, knowing full well that our team are here to support you and to ensure that you make the right financial decisions in a particularly volatile and nervous period. And if you have any questions or specific concerns, please click below and you can book in for a telephone call or meeting with me. I very much look forward to talking to you and meeting with you soon. All the very best, and we'll be in touch.